The world and markets have been waiting for a long time for a hopeful inflection point when Europe finally gets resolved. Now, according to our next guest, he believes that actually an inflection point is coming when we get a commitment to closer fiscal union, or we get the breakup. Ian Williams is CEO and chairman of Charteris Portfolio Managers, who manages the elite Charteris Premium Income Fund. Ian, you wrote those comments about this inflection point at the end of July. First and foremost, are you anticipating an inflection point in the next month or so, or are we having to wait longer for it?
No, not really. I think what's likely, as this crisis drags on and gets worse for the likes of Spain, is that the heads of the core European governments, which is basically Germany, France, Spain, Italy, and probably Holland, I think will agree some sort of heads of terms agreement, if you like, as a path towards fiscal union. I'm not suggesting they're going to sign a treaty in the next few weeks, but I think something is going to emerge, some sort of heads of terms commitment that will lead to full fiscal union 3, 4, 5 years down the road.
So that almost goes back on, I guess, my introduction, where there is a decisive moment in history where Europe goes one way or t'other. Looking at the history of Europe over the last 13 years, there's been nothing decisive at any stage. It seems that policy initiatives have been made in dribs and drabs. I fear that that union you're talking about, that closer union, closer agreement, the heads of state agreement, will be slow, and actually it won't give a clear signal to the markets to proceed that rally you're talking about.
Well, that's possible. I mean, certainly the history of Europe isn't one of dynamism. No one argued that. But what is the point in carrying on like this unless there's the ultimate goal of fiscal union? Nothing else makes any sense. And you might as well pack up the euro and go back to individual currencies, because it's causing too much pain in some of the fringe countries.
I'm inclined to agree with Ian, Steve. I've been spending a lot of time in Germany. I was in Germany again last week. Yeah, I think there still is a tendency among the commissariat, but not necessarily amongst market participants, to underestimate the political will of Europe's leaders for all the travails which we are going to continue to face, and particularly from this week on. In common with Ian, we've been looking through to this autumn, and we've been saying this is going to be a very difficult period. We all know what's coming up. We've got the ECB maybe going to disappoint this week. We've got Dutch elections. We've got the German Constitutional Court. We've just been talking about France maybe doing a 20 billion bailout. The French budget on the 26th of September for 2013 is already going to be a significant moment. Spanish country bailout, Italian budget. It's not at all unlikely, in my view, that before the end of the year, Ian, maybe at the December European Council meeting, Europe's leaders are going to have to come up with something which confirms that political will to take things forward. Timing, of course, very difficult, as I'm sure you'd agree. No one knows the timing. We just look at it. From the way we look at it, nothing else makes any sense. If they weren't going to move ultimately to fiscal union, what is the point? They might as well go back to individual currencies.
When you look at all the challenges, Alistair really outlined it fairly well, the amount of major stories for the investment markets to get through. At the same time, the positioning on markets, it's been a very low volume environment out there, but we've seen a rally in stocks, so it almost feels as though stocks are sitting on a cliff ready to tip off if there's any bad news. Where is the momentum for stocks to travel higher? Well,
we think that equities now are at ultra compelling value levels relative to government bonds. And for our clients,
what's the value equation though?
Well, you look at the yields for a start. I mean, you look at the dividend yield on a 10-year gilt is 1.5%, and dividend yield on blue chip equities like Glaxo's and Vodafone's and Diageo's is around 5%. Now, they're almost at record. You've got to go back to the Second World War virtually before you find the gilt equity yield relationship at that sort of levels. Furthermore, the gilt yield is fixed for 10 years, where these companies are increasing their dividends. So, as far as we can see, the valuation levels for equities are utterly compelling, and the risks contained are, if there are risks around at the moment, the biggest risks are in government bond markets, where the risks are asymmetric, where you stand to lose a lot of money at some stage when interest rates normalise, without the compensating reward you might make for taking that risk.
What you described there is an old-fashioned equity gilt valuation model, the Fed model as it's been known, and that's been discredited, hasn't it, at this point, with central banks so active in the market, driving down yields, that the problem is we can't actually get a proper read on relative valuation because of the distortion and the fact that the credit model is in fact fractured at this point. And when you try to find other data in equity values, you look at a case-Shiller where you get to obviously take the 10-year average. That doesn't look like compelling value. In fact, it looks, somewhere around the middle of where we might expect to be.
Well, we have to invest clients' money in the real world, and if I was investing your money, I think you'd probably prefer that I bought some Vodafone and Glaxo on 6% yield, and you might make some money in the future, rather than some 10-year gilts on a 1.5% yield where you stand to lose a lot of money in the future.
Well, I hope that your timing was superb and you switched me out of gilts just at the point where we had a confirmed long-term equity market rally. And that's the problem, isn't it? Timing is really the key here. You're not wrong. We know that these valuations are absurd currently. It's just when do you go? When do you decide that it's the moment to pull the pin and actually you get that explosive move upwards for equity?
Well, there's three core ingredients to any investment decision: timing, timing, and timing. And the cynical answer would be, if I knew the timing, I wouldn't need to sit here. I'd be on my yacht in the Bahamas. It's fairly clear to us that the long-term this is to us a tremendous buying opportunity for equities. If you didn't have all these problems, you wouldn't be able to sell gilts on 1.5% yields and buy blue chip equities on 5% yields. It's only because all these problems exist. And what we're looking forward, ultimately, the problems of Euroland are going to get solved. They're going to get solved by either a breakup or by some sort of move towards fiscal union. Either way, the problem will resolve itself in the future. We don't know when, no one knows when. Likewise, the problems in America are low growth. These are the valuations are set and they're very compelling.
Okay. Ian, thanks very much for coming in. Ian Williams, Chairman and CEO of Charteris.